Hi everyone, Pierre-Paul Turgeon, Canada's multifamily mortgage advisor slash broker, coming at you with a special edition of my Canadian multifamily investing insider blog. And it's breaking news, I guess a couple of days old news, pertaining to major policy changes by my former employer, Canada Mortgage and Housing Corporation, regarding multifamily financing rules. The first new policy change is with the removal of restrictions on the use of equity takeout funds at refinancing. Basically, back in 2020, at the onset of COVID-19, CMHC said that you can no longer use equity takeout funds at refinancing for whatever purpose you wanted. You needed to restrict the use of those equity takeout funds for purchasing another apartment building, and by that I mean commercial residential properties of 5 or more units. So using those equity takeout funds to buy another apartment building or build one, or pay for capital repairs that you had completed, or to pay out a short-term construction loan. CMHC was also very specific in restricting the use of equity takeout funds to distribute to your shareholders, which is a business model that myself and the majority of multifamily investors out there use. So it was causing quite a significant problem to our business model, and thank God we finally have some relief in that regard. Secondly, CMHC is also lifting the restriction on use of equity takeout funds for refinancing loans with non-CMHC approved lenders. Basically, what CMHC was saying is if you took out a loan with a non-CMHC approved lender, you want to refinance with CMHC insured financing, you cannot do that unless you wait 24 months. So a lot of people were stuck with conventional loans, which were not insured by CMHC at a much higher interest rate, because I'm sure you're aware that when you insure your loans with CMHC, you pay a significantly lower interest rate, roughly by 1%. So again, a lot of investors found themselves in trouble in difficult times, having to pay a much higher interest rate because CMHC wouldn't allow them to refinance their conventional loans by non-approved lenders with CMHC insured financing. And these restrictions were lifted basically to allow for freer flow of capital and eliminating the administration of these restrictions by lenders, which was very cumbersome. A second change that occurred was pertaining to CMHC MLI Select, the new program that CMHC came out with in 2022, by lowering the score that is allocated depending on how much you achieve the 3 social outcomes. So let me give you a little bit of context here for those of you who are not so familiar with CMHC MLI Select, and not to be confused with CMHC MLI Standard Program. We're talking about CMHC MLI Select here. Basically, MLI Select aims at achieving 3 social outcomes that you can see in the upper part of this slide. Creating more affordable housing, obviously to deal with the housing crisis. Secondly, creating more energy efficiency or more energy efficient housing by reducing green gas emissions, and creating more accessible housing for people with handicaps. The more you achieve these social outcomes, these 3 social outcomes, the more points you get, and the more you benefit from the flexibilities that are in this bottom part of this slide. Let's look at these flexibilities. If you get 50 points, your premium is reduced to 2.25% of the loan amount. You can borrow up to 85% of CMHC's lending value. In this case, we're talking about purchasing or refinancing an existing apartment building. You benefit from a lower debt coverage ratio, minimum debt coverage ratio, longer amortization. And if you get 100 points at the very bottom of the slide, you can get a limited recourse, meaning you don't have to provide personal guarantee, only guarantees by the corporation that holds asset. But if I go back to, for example, the affordability bucket, and again, this slide, we're looking at purchasing or refinancing an existing property. Under the affordability bucket, if you commit 40% of your units to remain affordable for 10 years, a minimum of 10-year commitment, and those units remain affordable for 10 years, which is defined at 30% of the median renter income, you get 50 points. Then if you commit 60% of your units to remain affordable, you get 70 points, and 100 points if 80% of your units are committed as affordable for 10 years. Whereas on the energy efficiency side, if you're able on an existing property that you're purchasing or refinancing to reduce your green gas emissions by 15%, you get 30 points. If you reduce them by 25%, you were getting 50 points, or by reducing them to 40%, you were getting 100 points. Well, now, as you can see in my slide in the circle there, you no longer get 30 points for a 15% reduction. You get only 20 points. You only get 35 points if you reduce your green gas emissions by 25%, and so on. Bottom line here, and this also applies for a new construction now that I'm showing you, so it's the same reduction in the kind of points that you're getting. You can no longer get 100% or 100 points by just doing energy efficiency, okay? You need to do some component of affordable housing to get 100 points. All of it can be all affordable housing, or a combination between affordability and either energy efficiency or accessibility. And the reason this was implemented was basically, because the emphasis by investors was all put on getting 100 points under the energy efficiency social outcome at the expense of affordable housing. And notice again, the change in scoring only applies to energy efficiency financing applications. So that's kind of it. So really, the program MLI Select at the basis, or the priority, I should say, for MLI Select is really creating more affordable housing in order to solve our housing crisis. So this new change in scoring is effective as of June 19th. The second policy change that came about was specifically for construction projects under a CMHC standard program, which is MLI standard program, not MLI Select, was to allow for the increase in the amortization period from 40 years to 50 years. Under MLI Select, you can already do that, but it didn't exist under the CMHC standard program. Now they're allowing that. Also, for projects in difficulty as a default management tool, which is, by the way, my previous job before I became a multifamily underwriter, you can also extend the amortization up to 55 years. So let me interpret that. So once again, this extension of amortization applies only to projects under CMHC standard program, because MLI Select already had 50-year amortization, as I just said, okay? But it is to increase also the quantity of multifamily projects that are being built by allowing a greater net cash flow, because we all know with inflation, construction costs are significant and the cost of money has gone up. But luckily, it came down a little bit yesterday by the announcement by the Bank of Canada, which we'll see in a moment. All right, and of course, for people building new projects because of inflation costs, and some of them at renewal are having a hard time making those payments, they're increasing the allowable amortization period to 55 years. That's also effective as of June 19th. Finally, the third or the fourth policy change that occurred is you can now build on formerly contaminated site as long as before your first advance you provide evidence to CMHC that the site has been cleaned up. Okay, and this again applies only to new construction. Again, it's always to create more affordable housing, and what it does, it allows for more land to be used to build affordable and more energy efficient and accessible housing. All right, that's effective as of a couple of days ago, June 4th. And finally, the good news that we got yesterday is that the Bank of Canada has finally reduced its overnight lending rate by 1/4 percentage point, by 25 basis point. And we can see the trend in the 5-year Government of Canada bond. It's going down. So hopefully more cuts are likely to be coming in the near future. So now that I'm a full-time mortgage multifamily, specifically multifamily mortgage advisor or mortgage broker, if you will, I don't do residential. I'm more than happy to help you with your financing either your existing projects or construction of new projects. You can scan my QR code and have access to me that way, or send me an email to pturgeon@maoki.ca. I'd be very happy to give you a free half-hour free consultation to give you some advice, to get you going on your way for free advice. If you want to pursue the discussion further beyond that free half hour, I will need these documents if it's for an existing project that you're looking at. If you're looking at building a new project, again, I'd be more than happy to spend 30 minutes with you. Send me an email and we'll set a time and I'll get you on your way to build, multifamily properties. The opportunity is tremendous. We do have a pretty severe housing crisis in Canada, but why let a good crisis go to waste, right? As a mortgage broker and advisor and as a multifamily investor, I'm super stoked by the housing crisis because I want to be part of the solution. There's tremendous opportunities. You have a guaranteed supply of renters. Rents are on the rise. So it's a low risk and interest rates are coming down. The numbers are going to start to look pretty good as more interest rate cuts are coming down the pipeline. As I said at the beginning of this post, I do have free master classes every Wednesday until the end of June on the topic of financing your multifamily deals like a pro, and I expand a lot more on both CMHC and MLI Select, the standard program, as well as conventional financing, which is non-CMHC insured financing. So you can go to the link at the bottom there and sign up for it. Hope to see you there. And I've got an 3-day live virtual workshop coming up as well. So check it out at multifamilyinvestingcanada.com. Hope to see you there. Cheers.